In particular, the price of silver it's finding equilibrium between the failing paper price system and the physical reality. This is a game where physical reality never mattered, but for a very small percentage. And now that is running headlong into a paper pricing system that has always been fugazi, as a word that you helped me with along the way.
Yes.
Their tricks of dumping late at night, their tricks of raising margins. It's running headlong into low liquidity, into backwardation, into exploding lease rates, physical shortage and desperation.
Keith Neumeyer pretty much was the coin of triple-digit silver.
Yeah.
I think once we get to triple-digit silver,
Precious metal head.
Well, yeah, that's definitely a good thing. We're going to come up with something good for that. But I think we go to quad silver. I think we got to go to four-digit silver. $1,000 silver. I think that's what we got to do.
All right.
And that way you can beat Keith to it.
The silver market is violently shedding its fugazi paper pricing structure as it collides with a physical reality defined by acute shortages and exploding lease rates. As traditional suppression tactics fail, experts warn that triple-digit targets are merely a stepping stone toward quad silver, potentially driving the metal to a staggering $1,000 per ounce. Andy Schectman, president of Miles Franklin, argues that we are witnessing the terminal phase of price manipulation as physical demand overwhelms paper derivatives. He contends that while $100 silver has been the long-standing target, the severity of the current shortage suggests the market must reprice far higher to find proper equilibrium. Schectman emphasizes that desperate institutional maneuvers, such as dumping contracts overnight or hiking margins, are no longer effective in a market plagued by low liquidity and backwardation. He predicts this loss of control will propel the metal past the $100 mark toward $1,000, fundamentally breaking the paper game and delivering true price discovery to those holding the physical asset. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
These banks, those that are shorting the metal, they don't just short metal. I mean, they have, these big commercial banks are involved in everything from interest rates to Forex to equities to commodities, and everything is very systemically connected. This is kind of the concept of the great taking, rehypothecated, systemically connected. This is the theory of Tom Luongo, where a smart man, where he is more or less implying that the US banks are net long now, flip-flopped, leaving the European banks exposed to this type of carnage. And his theory is that Trump is furious at the European aristocrats. It is his belief that Trump thinks that, and I don't know exactly where he got his evidence, but he's a very smart dude, and he believes that Trump thinks that there was election interference and color revolution that started by the European aristocrats that are the big European banks, and they're the ones exposed. So you get a bank like UBS that would collapse, and it would bring down many others with it systemically. So yes, it could very well do that, assuming there would be a domino of margin calls, and it would happen so fast it would just blow up the whole system. So good question, and this is why it's better to have physical possession and stay out of the way of margin, of leverage. Don't ever buy gold on margin if you can avoid it, and just take physical possession of it, and you can stay out of that carnage.
Keith Neumeyer pretty much was the coin of triple-digit silver.
Yeah.
I think once we get to triple-digit silver,
Precious metal head.
Well, yeah, that's definitely a good thing. We're going to come up with something good for that. But I think we go to quad silver. I think we got to go to four-digit silver. $1,000 silver. I think that's what we got to do.
All right.
And that way you can beat Keith to it.
In particular, the price of silver it's finding equilibrium between the failing paper price system and the physical reality. This is a game where physical reality never mattered, but for a very small percentage. And now that is running headlong into a paper pricing system that has always been fugazi, as a word that you helped me with along the way.
Yes.
Their tricks of dumping late at night, their tricks of raising margins. It's running headlong into low liquidity, into backwardation, into exploding lease rates, physical shortage and desperation. I mean, it is because, like, for example, you look at this TD Bank, and TD Bank, these idiots, Canadian bank, they sent a letter out to all their people. They're saying, yeah, silver's going to collapse. We think it's topped. And as a result, we're going to put on a short, and it's going into the 40s. They just got stopped out at 92. And I think the point that is important to make is that any bank that would be stupid enough to go naked short into a market that is in backwardation, where they're paying a premium for it right now, is either really stupid or they're just forced to do it to mitigate the losses on their books. And I think it's important. You keep hearing this from other people, but I think it's very true that this is a repricing. This is a market that has never been allowed to spread its wings, to find its true self, to find price discovery. This is not a temporary peak. This is repricing in real time. I do believe that. The physical conditions are such that could create some real chaos in the market. This wasn't a technical event, as far as I'm concerned. What it was probably they were forced to do it because of a huge position. They thought they could mitigate the pain. This is how accidents start, by making a stupid trade like this. And quietly they got stopped out. But the old tricks, like I was saying, dumping in the dead of the night when liquidity is lowest, prices go down, raising margins. None of this stuff is working anymore, and it always did. So when you say something like this is a strategic repricing, it feels like it, not only because the war, it's not speculation and leverage like we saw in 2011. Therefore, when they did raise the margin account, it killed the rally. This is sovereign nations running to it. And we've talked about the critical mineral designation. We've talked about the exports out of China, all that. But also, there was just a law passed by Trump saying that within the next 180 days, all of these critical minerals will be given a governmental price floor underneath it. Now, that has a lot in my mind to do with incentivizing domestic mining. Because if the all-in cost on silver right now, they say, I was doing an interview with Peter Spina today, and he said that by his numbers, it looks like the all-in cost for silver mining break even is about $40. Getting there. So you have to have a whole bunch of room in there to incentivize profit motive these companies, because mining is a very expensive endeavor. And to start up a mine from scratch is tough. There are people that are well read, they read the wrong shit. We talk about that all the time.
No doubt.
And he is well read and very successful, and I like him a lot. And you don't get to his level, and I know the level he's at without knowing your stuff, right? But guys like him, they're trained not to see the things that I see. Right? Because they're trained to look at the things that the mainstream looks at. They'll look at charts, they'll look at ratios, they'll look at headlines, they'll look at ETF flows, but they're not looking at the deliveries. They're not looking at the lease rates. How much does it cost to borrow this stuff? Currently, the lease rates are 8 or 9%. They're normally 1/4%. That signals amazing stress, coupled with backwardation. Backwardation says, no, I want it right now. I want it right now. I don't trust you in the future. They're not looking at who's shipping the metals out, who's taking delivery of it. In December, 68 million-ish ounces of silver delivered into COMEX, the largest December delivery in the history of the COMEX. But do they notice that this has been going on for 15 months? I've been screaming about it. Where's Jim Cramer? Where's CNBC? Where's Fox? Where are they? Why aren't they saying who the hell's doing this? And that is why a very seasoned, successful trader looks at it and says that these are markets that have never found true price discovery. And by the time the system admits this stress, this positioning opportunity, it's gone. And they're not going to see the stress. This isn't a peak. This is repricing. And peaks happen when supply, catches up. The supply is so far behind. Supply is disappearing. And once the paper market loses credibility, like it is right here and right now, Kevin, price won't just rise gradually. It will slingshot. And I think that's the issue. It has lost credibility on many levels. So I think that for a guy to say that, I get it, because it is overbought, technically maybe, but technical analysis in a market that has been suppressed and rigged for a very long time, and I don't care what anyone says, it has been.
I agree.
And markets don't behave the way that these markets do. Like when you see a knockdown at 3 a.m. when there's no volume and the traders in New York are asleep, and they dump millions of shares on there to create an effect when there's the least amount of liquidity, period. That's done as a drive-by shooting to guarantee the worst settlement. These are the kind of things that Ryan doesn't.
The global banking system is facing a precarious domino scenario, where the intense interconnectivity of financial institutions creates the risk of rapid systemic contagion. This vulnerability is highlighted by the Great Taking theory, which suggests that European banks, specifically giants like UBS, are dangerously exposed to a short squeeze in the precious metals market. This geopolitical friction is reportedly being exacerbated by a strategic rift between the U.S. administration and European aristocrats, who are reportedly using the silver market to exert pressure. Evidence of this stress is already visible. Major institutions like TD Bank have been trapped in short positions, forced to cover at substantial losses as prices surged past their stop losses in a market devoid of liquidity. Simultaneously, a massive domestic policy shift is underway to secure America's resource independence. New legislation mandates the establishment of a governmental price floor for critical minerals within 180 days. This move is designed to incentivize domestic mining by guaranteeing profitability well above the current break-even cost of roughly $40 per ounce. Market analysts argue that this combination of systemic banking stress and government-backed price supports will drive silver far beyond the popular $100 target. The trajectory is now pointing toward quad silver, a 4-digit valuation of $1,000 per ounce, as the only price capable of balancing the physical shortage and shielding the strategic asset from foreign accumulation. Let's get back to the interview.
Yep. We've talked about repricing of gold, and we've mentioned James Rickards, 24,000. We've mentioned Mike Maloney, 10,000. We've mentioned a lot, but here's a new one, Van Eck. Van Eck is the big mutual fund company, and I want to read something to you. It says, what if gold replaced the U.S. dollar as the reserve standard? Now, I have been saying for the last almost year that I believe they want to softly default on the U.S. dollar. They want to default on the reserve status in order to not only pay down the debt, but bring back manufacturing.
Yeah.
Okay. So it says, in this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves, implying a 39,000 to 184,000 per ounce spot price. They use it in 2 examples. They use MO. Now, MO is something you don't hear about a lot. It's usually M1, M2. Yeah. MO would be the amount of cash that's immediately available, right? And it is money liabilities that would, I guess it would just be cash in the system right now. Just immediate cash. Divided by gold reserves is 39,000 per ounce is what they would say. But using it says, using a sample of major global central banks' MO money liabilities divided by their gold reserves and weighted by their share of global daily FX turnover, we calculate the price of gold that equalizes MO is 39,210. However, if we use central bank M2 money liabilities divided by gold reserves, it is $184,000 per ounce weighted by daily FX turnover. The point I want to get at is here you have a company that is not in the business for selling physical gold or talking about it every day, saying that you could see $184,211 price of gold. Now, that would go hand in hand with my belief. Now, if you believe Judy Shelton, he says we're going to back the back end of the bond market with gold. So you sell a $20 million bond redeemable in gold in 30 years, and you sell it at $5,000 an ounce gold, and it goes to $184,000. You just 30 times less the amount of gold that you need to deliver in 20 years.
That's right.
So it would follow, and the rising of gold to that level would massively devalue the dollar. You have a devalued dollar. You have the ability to have not only credibility with your bond market, but you have to give less at the end, no upfront borrowing costs. I mean, it's all starting to come together. The things that I've been talking about, it's almost kind of scary.
It is.
And to see them, a company like this, a fund talk about this, I found it very interesting. I think there should be caution with equities just simply because you have 7 stocks holding up the other 493.
I think it's very rich.
It's rich. There's very little. Look, there's a disconnection between Main Street and Wall Street. Main Street is having a hard time. This is the K-shaped economy, the Cantillon effect. those closest to the money supply who own assets have gotten exponentially wealthier. And the people who have no assets have gotten exponentially poorer because the cost of living and the things that we need are eroding daily living expenses. And it's something I don't like very much, to be honest with you. I think it creates a lot of divisiveness and separation between those who got it and those who don't. But that's exactly what I think this rally has been about. The wealthy who own the stocks, the wealthy that own the equities, the wealthy that own the commodities, the wealthy that own assets have gotten wealthier. And if you look at, does this economy support these types of valuations, I would argue they don't. And maybe that's why we've been seeing so much in the way of investor insider selling. I can't see it continuing to rally at this level. But with that being said, with inflation and the effort to suppress interest rates, markets can stay irrational longer than we would expect, and longer than those shorting it can stay solvent. So not sure how that all ultimately plays out in the near future. The uncirculated coin was also $179. Now, what's the difference? I own some of both. The commercial striker and the tubes and the boxes. The proof coins, if you take a blank silver eagle before it's a silver eagle, it's called a planchet, just a blank disc, right? The proof coins are struck 4 times or so for greater definition after being polished under an industrial buffer to see your reflection, put in a velvet box, and in this case, sold for $80 over its melt. The commercial strike coin is struck once and put in tubes of 20 and boxes of 500. Now, the uncirculated coin, in my mind, is very much the same as the commercial strike, although it comes in, instead of the velvet box that goes into another box, you just get another box without the velvet box. And inside of that small box that you get says U.S. Mint on it. It's usually blue. There'll be a little plastic insert that will fit the uncirculated coin, and it probably comes in a capsule. It's not proof, and it's not commercial strike. It's uncirculated. Big frickin' deal. It's as dumb as putting lipstick on a pig. The proof coin, okay, cool. I mean, they're nice. They make cool gifts, shiny and quite awe-inspiring. If you've never seen one, it's beautiful work of art. And in the proof version, it's amazing how beautiful it can be, and the detail, and it's quite startling how wonderful it is, but not something that should be the bulk of your holdings. You want commercial strike. You don't want to pay an $80 premium for a proof coin.
You want to put that premium into more metal.
Right.
That's what you want to do.
So in any case, the U.S. Mint did not do that, but there's a lag sometimes in their figuring stuff out. Dunnigan was talking about, there was all sorts of people last week talking about the fact that you could buy proof coins on the U.S. Mint website for $99. And that's true, you could.
Yeah.
And then this happened. They're like, oh, wait a second. And then they halted everything and went in and repriced it all. And now it's 179. So anyways, the Silver Eagles have not moved up to 179. But I'll tell you one thing, they're over $100 everywhere in North America and across the globe. So we are now across, which I can't even believe, we're over $100 a piece on Silver Eagles just in regular commercial strike coin.
Mainstream finance is finally acknowledging the U.S. dollar's precarious position, with major firms like Van Eck Publishing Models suggesting a radical revaluation of gold is necessary to balance global liabilities. Their analysis indicates that if gold were to back the immediate monetary base, MO, prices would need to reach $39,000 per ounce, but covering the broader M2 money supply pushes that figure to a staggering $184,000. This aligns with the theory of a soft default, in which the U.S. effectively allows the dollar to devalue against hard assets to extinguish debt and reshore manufacturing nominally. Market observers note that this repricing is already visible in government actions. The U.S. Mint recently halted sales to implement aggressive price hikes, raising proof Silver Eagles from $99 to $179. While these collectible coins often carry high premiums, the move signals that even official entities are preparing for a triple-digit reality. With standard commercial silver already trading over $100 globally, the window to acquire physical weight before the official revaluation completes is rapidly closing. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.